Welcome to the Nasdaq Market Site. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me on set, we have Sean Feeney, also with Nasdaq, and Tony Zhang with OptionsPlay, and we're going to focus on hedging a portfolio with NDX 100 options. It could not be a better time to talk about hedging with the volatility that we've seen in the markets. Before we get to some of the strategy, Sean, I want to ask you if you can tell us more about the Nasdaq 100 index.
Sure. So the Nasdaq 100 are the 100 largest stocks that are listed on the Nasdaq exchange that are not inside the financial sector. There are multiple ways to gain exposure to the index. NDX, which is the larger portion of that index product itself. We have the 1/5 value, reduced value product, NQX, for a trader that would have a little bit less notional risk. And we have our partners with the QQQ, with Invesco Power Shares, and the CME NQ Futures product as well.
Right, and you can trade options on the NDX.
Absolutely.
All right, now Tony, what is a portfolio hedge and why is NDX and NQX a good fit?
So a portfolio hedge conceptually is fairly easy to understand. It's really just reducing portfolio exposure during a market correction to offset any risk. However, conceptually that's easy to understand. Sometimes in practice it's a little more difficult. Before we get into that, I do want to say that the cheapest and most efficient hedge you can put on your portfolio is simply moving into cash when you do expect the markets to fall and then reinvest in those assets when you expect that correction is finished. However, that sometimes is not an option for everyone. So if you can't sell your investments into cash, one thing that you can do is buy a put option on a broad-based index like the Nasdaq 100. And that put option is very similar to an insurance policy that will actually increase in value as the market corrects, which offsets any losses that you have in your actual portfolio. So that's just a very simple hedge that you can put on for your portfolio to mitigate any risk during a market correction.
All right, and Sean, what are the benefits?
The benefits are, as Tony described, as the market falls in a volatile environment, those put options will gain value. The cash settlement feature of the NDX is really where we want to kind of focus because there is no physical deliverable. These options will settle into cash. So there's no need to really worry about hedging an additional position after the fact once the position expires. Also, there are tax efficiencies to trading broad-based index options where 60% of your gains inside of that broad-based index option space are taxed as long-term gains regardless of holding period. So that 1256, and I do urge investors to consult their tax accountant before investing in Nasdaq index options and settling this into the 1256 style product. But those benefits exist.
All right, so Tony, let me ask you a question. When you're looking to put on a portfolio hedge, how do you determine what strike and expiration you want to use?
Yeah, so buying puts on a portfolio is actually quite an expensive operation, so it's really important to be very tactical. One of the the expensive piece is really the time value that you're losing on the put option. So one of the ways to mitigate some of that expense is to actually go a little further out in time. Usually 2 to 3 months out in time is enough. Even if you plan on only holding that hedge for a few weeks, going out 2 to 3 months will mitigate some of that time decay. And as far as what strike prices, it's almost like buying an insurance policy. You can buy either catastrophic insurance or more comprehensive coverage. So if you're looking for something just as a catastrophic insurance, you can buy an out-of-the-money put option. These are usually fairly cheap. You can pick them up usually for 1 to 3% of the underlying portfolio value. That'll protect your portfolio if the market was to drop more than 5–10%. Those are the types of protection that you get versus a bit more comprehensive insurance you could buy in the money put. Those will be a little bit more expensive, closer to 5%, I would say, where you get closer to dollar for dollar coverage on your portfolio. So those are the different choices that you have in terms of expiration and strike prices for a portfolio hedge.
All right, and Sean, what are some best practices when you're putting a hedge on?
Well, as Tony described, buying a put option on the NDX can be expensive. And there are ways to offset that cost. You can either sell an upside call option in order to offset some of those costs. Now, there are margin challenges to that, so potentially even selling an upside call vertical spread, where you're selling a call on a higher strike and then buying a call on a slightly higher strike than that, which will have some margin benefits as well as generate income into that strategy and offset some of the costs of buying that put.
All right, and Tony, I'll ask the same question of you. What are some best practices with hedging?
So when it comes to best practices, I usually always say that it's better to be late than early when it comes to buying a put option, because this is really where, because it's so expensive, you want to be very tactical. You don't want to anticipate a market correction. Sometimes if you do that, you end up paying insurance for nothing. And also, I generally tend to find that it's better to buy a more comprehensive insurance, buying an in-the-money put option, because you also at the same time mitigate some of that time value when you buy an in-the-money put option. So those are my two tips for buying a portfolio hedge.
All right, well, thank you so much for joining me today. And be sure to check out the full webinar on NDX 100 options and hedging. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.